What's up, everyone? We're going to talk about max pain modus operandi. Sure you've heard of it, also known as max pain. Let's go ahead and take a look at what this is all about. So before we begin, let's just go back to the basics. An option contract is the right but not the obligation to buy or sell something at a stated date at a stated price. Options are leveraged instruments, meaning they permit traders to enhance the advantage by risking littler sums than would some way or another be required if exchanging the underlying asset itself. The roots of option pain dates back to 2004, one might say. This is as yet an exceptionally youthful theory. To the extent we know that there are no scholarly or educational researching as far as when it comes to this novel field of study. There hasn't been many scholarly articles or educational research done on this topic. This article that we're reading now is from 2020. Now, the theory of options pain roots as inference that 90% of the options lapse useless. Henceforth, options writers or vendors will in general bring in return all the more regularly, more reliably than the option purchasers. So basically they're saying the option writers or the ones selling calls are going to make more money than the people buying the calls. That is 100% correct. We see it week after week in the options chain. You see a high amount of volume and a low amount of open interest. That's retail. If this consensus and announcement is valid, at this juncture we can make a lot of consistent reasonings. At any point, just anyone can bring in return that is either option vendors or option purchasers, and yet not both. So one or the other is going to make the money, the option vendors or the option purchasers, but it seems that both cannot. Okay, PowerPoint's jacking up on me. So if option vendors will in general bring in most extreme returns, at that point it likewise implies that the cost of the option on expiry day ought to be headed to a point where it would make least measure of misfortune to option writers. Now if point 2 is valid, at that point it further suggests that choice costs can be controlled at any rate upon the arrival of expiry. If point 3 is valid, at that point it further suggests that there exists a group of traders who can control the options costs at any rate upon the arrival of expiry. If such a group exists, then it must be the option vendors, since it is accepted that they are the ones who bring in most extreme return and reliably bring in return trading options. Presently, contemplating all of the above focuses, there must exist a solitary value point where, on the off chance that the market lapses, at that point it would make least measure of agony the option writers, or cause the most extreme measure of torment to alternative purchasers. On the off chance that one can distinguish this value point, at that point almost certainly this is where markets will expire. The option pain theory does only this, recognizes the cost at which the market is probably going to terminate, considering least measure of pain is caused to option writers. Here is a step-by-step guide to calculate the max pain value. At this stage, people may find this a bit complex, but the following steps will get clearer once we take up an actual model. Now, this is basically it. There's 5 steps. Step 1 is list the different strike prices on the trade and note the open interest of the both of, and apologize for the language. This was written in pretty poor English, so apologize about that. It's basically saying list the different strike prices on the trade and note the open interest of both the calls and puts for these strike prices. Step 2 would be for every one of the strike price that you have noted, presume that the market expires at that strike price. Then calculate how much return is lost by option writers, both call option and put option, presuming the market expires according to the presumption in step 2. Fourth step is add up the return lost by call and put option writers. Lastly, identify the strike price at which the return lost by option writers is minimum. If the strike price at which money lost by the option writer is minimum, it is the point which maximum pain is caused to option buyers. With this idea, the market price is most likely to expire. So on their end of the field, it's minimum pain. On our end, it's maximum pain. So max pain applies to us, not the ones writing the contracts. Now, if the strike price at which money lost by the option writer is minimum, that's the point at which maximum pain caused to option buyers, and it works vice versa, with this idea that the market price is most likely to expire. Now, let's talk about the put-call ratio. The PCR, or the put-call ratio, is the proportion that encourages distinguishing extraordinary bullishness or bearishness in the market. Put-call ratio is generally viewed as a contrarian marker, which means on the off chance that the put-call ratio shows extraordinary bearishness, at that point we anticipate that the market should switch, thus the vendors turn bullish. Moreover, on the off chance that put-call ratio demonstrates extraordinary bullishness, at that point vendors anticipate that the business sector should opposite and decrease. To compute put-call ratio, one should simply isolate the all-out open interest of puts by the all-out open interest of the calls. So this is an example. We have a table here. We have strike prices right here. We have the call open interest here. We have the put open interest here. To calculate the open interest ratio of put-call ratio, simply it's basically just the proportion between the put option interest divided by call option interest, and that gives us the PCR ratio. So in this example here, this was measured on 15th of May 2020. The option interest of puts and the option interest of calls have been computed, and we have 370. That's not even, he didn't write those numbers right. He missed the comma. It's supposed to be 37,016,925 divided by 442,874,200 to give us a 0.863385 PCR. Now the general consensus of PCR is over 1. At that point, it brings that there are more puts than calls. Obviously, this suggests that the business sectors have turned very bearish, and thusly kind of oversold, and the other way around. Obviously, the non-exclusive way to deal with the put-call proportion is the quality somewhere in the range of the 0.7 and 1.0 mark. That can be ascribed to normal trading activity and can be disregarded. So we want to look for numbers for put-call ratio below this and above this to give you an indication of non-normal trading strategies. Now, what might truly bode well is to truly plot the day-by-day put-call proportion for, say, 1 to 2 years and distinguish these outrageous qualities. It is likewise that the put-call proportion is utilized as a contrarian marker. The clarification is somewhat precarious, yet the general feeling is this. On the off chance that the merchants are bearish or bullish, at that point the majority of them have just taken their individual position, henceforth a high or low put-call proportion. And accordingly, there are very few different players who can come in and drive the situations in the ideal heading. Conclusion. The put-call parity is an option-price relationship that, if violated, generates a straightforward arbitrage trade that does not require rebalancing or information about volatility. It's seen that maximum pain and put-call proportion technique is more than adequate for retail merchants to exchange options expertly. A considerable lot of the best alternative trading techniques are straightforward, rich, and simple to execute. By considering the less unpredictability in count and wanted rate of return in options, it is demonstrated with the above models that maximum pain and put-call proportion are more than adequate. Join us at the Discord. Let's go. We have some opportunity to take advantage of.